So good morning, and active traders, and welcome to our Win with Ken pre-event coaching session. 10 minutes to potential success. As always, all information is for educational use only. I'm not making advice about what to buy, sell, or hold. By watching this, agree to not make actual trades. We're not making any profitability or performance claims. This is all for learning use only. Do consult with a registered investment advisor before you take that trade. So I've only done 513 frickin' trades this month, all right? And this proof is a screen cap from my Fidelity account with my account thing balanced out. So you've seen how many winning trades and how many stops I've made and the lessons learned. That's why traders trust me, because I'm the real deal. I actually really trade, and I learn the difference between what works and what doesn't. So for example, people are not buying the dip. So I got stopped out a lot of my speculative small size swing trades because buyers were not coming back in. So that's fine. You go to cash. You take small stops. The main idea this time is look for midday pivots caused by institutional buy and sell programs. Oftentimes near 11 or 12 you'll see a midday pivot to the upside or the downside, and I'll show you what I mean by that in just a minute. How about like right now? So what I mean is, for example, if you trade VXX like I trade VXX, I was stopping out of it a winning swing trade. I'd bought here for an overnight swing, and I was selling into the retracement because this is right near 11 o'clock, and oftentimes you'll see pivots at 11 or 12. Sometimes you don't see it, like the S&P. You can see, for example, the spiders on Thursday. We didn't have any sell pressure come in midday, which is unusual. Usually you see a reversal, a mean reversion or a reversal near 11 or 12. We did see that yesterday, right? The S&P had a upside after a weak start. It crashed and burned, it came back to life, and it kind of ended flat, so indecisive. But we saw the pivot here and here. Trading within those pivot zones is one thing that I teach how to trade, because you have to be on the right side of that if you're going to make it. Okay. I wanted to say congratulations to all of you who are Swing Scans members. I've been correctly calling things like the 3850 long and ERY last Saturday. Congrats if you took that alert. Worked out brilliantly, along with some of the other inverse ETFs that you guys got. Here's the charts I'm trading, and I'm currently long in. And for proof, you could see my Twitter feed of screen cap of my Fidelity account from yesterday. VXX, SRTY, really nice clean pattern. SDS, QID, not as clean. TZA, really good chart. TVIX, FAZ, SQQs, and LABD. One of the things you want to start doing as an active trader in our current markets is make sure that you are looking for the strongest continuous plays and start using much more a position sizing or scaling approach. Because, you know, I was trading these guys from earlier, and you may get in on the first breakout, but if you get stopped out and then miss out on the big run, what good is that? Or if you get stopped out on this mean reversion. We're in a mean reverting market, folks, and so you'll often see the breakout run, and maybe you buy the top, and then you get stopped out on a retracement to a major moving average line. The trick is you got to re-enter on the pivot. You don't want to wait for a new high. In this market, we've got such extreme volatility. It's really important that you trade more aggressively in hot markets, right? That's put the pedal to the metal. It's like driving a car. Here in Colorado, we can go up to 75 miles an hour on our I-25 interstate freeway, which is cool. So I drive 75 miles an hour on the freeway, but I only drive 25 miles an hour or 20 miles an hour here in the suburbs. And as a trader, when the markets are hot, you've got to be on the freeway, not in the suburbs. You got to match your trading style professionally to the types of setups that the market's given you. So let's see here. Let me give you a couple of examples of real money trades I'm in. Let me ask you guys again. Last week or 2 weeks ago, I said, do you think the market's going up or down? And shockingly, over half of you said, a substantial number of you incorrectly thought the market was going up. Let me ask you again. Do you think the markets are going up or down from here? Please vote. This is the S&P. Now, is it worth buying the dip? Well, if you listen to the financial head commentators, they talk about the macroeconomic picture. For example, we've got weak earnings reports that came out last week. We got new earnings reports coming up next week. We got strength in the U.S. dollar, which is bad. We've got potential recessionary fears coming up first quarter 2019, which is bad. We've got relative strength pockets in certain sectors like healthcare, automotive, and home builders, which are starting to bounce. But I'm not sold. What I care about is what the big picture market's doing. And so almost all of you are saying down now, so that's good. And from Chris, yes, the S&P under the 200 MA means a ton, which is why I told you guys back here, if we lose the 200 SMA, kiss it goodbye. And I was right. We got the little fake out bounce, and then we crushed down here. So the price that proves my inverse ETFs wrong is what? If the market rallies back to above the 200 SMA. So good question, Chris. So that's the price market-wise, big picture-wise that moves. Now I'm going to duck and weave faster than that, but I would not be a dip buyer of anything unless it's called on the street. We call it a 3-day rule. We want to see a sequence of 3 sequential days above the 200 SMA before considering going long in anything. I don't think that's going to happen anytime soon. I think we've got pain ahead. Right? So let me share with you some of the things that I'm looking at. And again, welcome aboard. Our official event starts in just around 5 minutes. Thanks to all of you from around the world for being here. Here's my Twitter feed. Do register, or whatever you call it. Follow me on Twitter. There's P&L proof of 513. Lucky number 13 trades generating $2,500 in commissions for Fidelity. Good for them. I've had both up and down days, right? The goal is to make your down days less than your up days. And here's an example of a screen cap of the positions that I built into the close. That's why the P&L is slightly red, because I bought, I think it was like 330, and then they all went slightly against me. So no big deal. No harm, no foul. Slightly in the red, but in an aggregate current value of over $17,000. These are all inverse ETFs that I'm long in. Okay, so that is something to pay attention to. We will see if I'm right. I could be wrong. It wouldn't be the first time. But as a trader, the trick is tight stops when you're wrong. So there's a price that proves me wrong. But I'm expecting that ultimately I should be correct in these trades. So the market crashes and burns. Remember, the market heads down faster than it goes back up. And fear is a more powerful motivator than greed. So, and I don't hear a lot of, fortunately, I don't hear a lot of people on the financial news TV saying stupid things like, buy the dip, everything's oversold. Though some are, but most of them are kind of, is this the beginning of the big rundown? So we'll see. Got so many great charts to work with. One of the things I think can really help you in your trades is develop a plan and stick to it. Have a step-by-step strategy, kind of a, how are you going to scale in gradually over time? And do use things like candlestick patterns for reversals, as taught by my colleague Steve Nissen. The 2 guys I've learned the most strategically valuable information from as a trader. I'll say 3. But over the years, recently Tom Sosnoff, because I've only been recently watching his brilliant YouTube channel. He talks about volatility and risk management. He's brilliant. Tom Sosnoff from Tasty Trade, formerly co-founder of Thinkorswim. He's brilliant. Steve Nissen for candlestick patterns, especially reversals. And like he always says too, which is always in the back of my mind, he always says, you know, there's a price that proves the trade wrong. What is that? Make sure that you stick to that, right? And that's really helped save me a lot. So thanks to Steve. And also Dr. Van Tharp for the whole concept of position sizing or scaling in. So I'm not like betting my whole retirement account on the market short. I went in relatively very small size, but I will scale in if these guys keep running on up. And the reason is because there's some freaking awesome upside. Split adjusted ERY, 7,000 a share. Now on sale for the low fire price sale of only $40 a share. Do you think there's some upside potential there? The trick is when you scale in or position size in, what I found is unless you got a straight up chart like Square used to be, or Nvidia, or Disney, or Netflix, or Apple, or whatnot, unless you have a chart that's going reasonably clean 45-degree angle up, you're going to get stopped out on pullbacks if you scale in too soon. So you've got to always be playing with the house's money and use wider entries. That's what I'm going to use to scale in. I made my bets, but for example, in this guy, ERY, well, let's take a look at one I'm in. I'm not in ERY. I should be in ERY. I'm in SRTY. For example, SRTY I bought in here. I likely won't buy again till over 37. Okay, and then again over 40, then again over 43. And if it pulls back and drops and chops and bounces, then I'll slowly stop out along the way down and buy any pivots on the way back up. So a very active, intelligent way to trade is this is a trader's market. This is not an investor's market. You know, if you're an investor, may the good Lord above have mercy on your soul. That's looking butt ugly, right? What we're looking for is a retest of the earlier, the 2530, 2500 February lows, and we'll take a look at that in just a minute. But anyway, those are the kind of things you want to start looking at in our current markets to stay on top of it. Ignore the talking heads. They're dangerous to your financial health. Let's be value dip buyers on oversold blah blah blah. Oversold is the stupidest word in the trading language. Overbought is equally stupid. All that matters is small stops. That's all that matters as a trader, is small stops. Like I took a bunch of small stops this past couple weeks. That's okay. I'm still doing great because I take small stops. Be wrong real small. Be right just slightly better, and you got it made. That's all you got to do as a trader. Hey, do remember to join before we start our official broadcast, actually we're on schedule to do that right now, do consider joining my Trade Mastery coaching program. You have my word, it's very valuable. We'll be going over a lot of advanced tips for especially tailored to our current markets using real money trade examples I'm in, and how to enter and exit and what kind of patterns visually to look for that are working right now, you know, using current market real trade examples. So there's that. With that, let's go ahead and get underway. Weapons hot, let's light them up. I've got your 6. I got lots of buddies in the military and law enforcement, so I end up with cop talks. There's bad guys and perps and condition white, condition red, condition yellow. Copy that. Let's get underway. Remember, midday pivots caused by buy and sell programs, something to be on the lookout for. All right, so welcome aboard to the world's active traders. Great to see so many of you here in today's broadcast for Trading Week Ahead. I'm Ken Calhoun, your host, active real trader, doing hundreds of trades, 500 trades this month alone with P&L proof. As always, all information is for educational use only, not making advice about to buy, sell, or hold, but what's insecurity and not make actual trades. Sometimes you got to say what our quote of the week from one of my favorite movies, Risky Business, from Miles, is saying sometimes you got to say what the F, make your move, you know. And in the markets, isn't that true? Sometimes you got to say what the heck, make your move. So your parents are out of town for the weekend. You've got the house all to yourself. What the fudge, right? As a trader, so the market's collapsing and going the F down. What are you going to do? Sit on the sidelines and go, oh no, the market's going down. Let me watch financial news TV. That would be a bad choice. Instead, you want to make frickin' money in the market, right? If your trading losses are making you or your family say, what the F? Stop the madness. There's got to be a better way. You want to do something a little bit differently. Join my coaching program. Anyway, Trading Momentum Part 4. I do want you to start looking visually for pivots caused by institutional buy or sell programs around 11 or 12. I was watching a good video on YouTube. CNBC speaker is Kenny Polaris, I want to say. Kenny something. And a smart guy also by the name of Ken. Shout out. He was talking about the cascade effect of institutional sell programs. As we lose support, the algos will kick in, and that drives things down, and that leads to a kind of a cascade or domino effect where volatility begets additional volatility, or sell pressure continues on down. So got a couple more tips that are kind of more useful than just that general tip coming up for my Swing Scans members in just a minute. Do be sure to join if you're not yet a member. Let's go ahead and take a look at our S&P. Last week, gang, I told you we go short under 27.45. Congratulations if you listened. to that tip. 27.45 was in fact a really good sell signal last week. This week, let's do 27.75. I'm an ultra skeptic on this thing coming back to life. So you don't want to be a dip buyer. This is a lot of large red candles. Look at the ratio. This is one thing I teach institutional traders. Look at the ratio of green to red candles. What's the mix? We got, well, 3 modest green candles and 2, 4, 6, 8, 10 big honkin' red candles. So we're in a 10-to-3 ratio red candles to green in the last couple of trading weeks. We are significantly under the 200 simple moving average line. That's the line in the sand, and that's what kicked in all the selling pressure here and again here and again here. We had a bull trap day on Thursday. The market did kind of a little fake out to get the newbie dip buyers in and then crushed their hopes that went down, which is why I was shorting the market, right? So I know how to trade. Anyway, S1 level is 26.10. Look out below if we continue on down under that 26.10 level. Strategically, on the 1 year, we have key technical support near the 25.50 region. So if we lose that technical level, watch out below. And yes, you do use the shadow of the candle. That's factored in algorithmic trade. So that's the year's low of the market. Keep an eye out on that. These are the 2 most important lines on this chart. The 200 simple moving average line and the annual low of 25.40. There's nothing to say that it's going to get a bounce. I'm positive we'll get some kind of an anticipatory bounce ahead of it. Maybe even here at the 25.60, 25.52 or something. But if it loses here, kiss the market goodbye. It's going to crash and burn like a son of a gun, and I'm going to make a frickin' fortune. So anyway, I hope the market keeps going down. I fully expect the market will try and screw me on Monday, and we will see a rally on Wall Street against my short positions. But I'll still come out ahead because I know how to trade these guys. I fully expect the market's going to try and screw up my trades. And it's that's how I anticipated correctly the Thursday price action, right? What I did was I closed out the trade, stopped out on the way down off the 11 o'clock pivot, and I rebought into the close on Thursday. Okay, then I sold down again on the 11 o'clock pivot, and I rebought into the close yesterday. So that's a good, intelligent, professional approach to use. And I'll go over the mechanics of how to do that in my subscriber services for my members. So, but that's just a quick professional trading tip, is you've got to learn how to trade pivots and reversals correctly to manage risk intelligently and make trades that actually make sense. Let's take a look at a few charts, shall we? TVIX is my favorite. It's ran up. It got slightly over the 200 moving average near 56 yesterday, which is significant. Notice too, please, the large green candle here that pierced the 100 SMA. We got a pivot, a mean reversion pivot off the 100 SMA. Now it's right over the 200. A couple other charts to keep on the radar. Why? Let me zoom in on these guys for you. This is not a dip buying market. I learned the hard way. I got stopped out a lot on itty bitty trades, inexpensively per trade because it's very small share size, which is the right way to learn. The dips are not getting a lot of buyers. And the reason is there's so much sell pressure and skepticism on the street. Even if you do get, and I picked a lot of great charts that had sold down and were significantly and were starting to bounce a little bit, but the problem is buyers are not coming in to lift it up further. That's more what? What kind of traders do you think are responsible for little tiny bounces after big sustained sell-offs in our current market environment? It's a quiz question. Feel free to answer. Wow, big turnout today. A huge turnout today. Thanks everybody for being here. Learn how to kick the market's ass. What kind of traders are coming in? And don't say dumb traders. Technically, what's going on if you see small, unsustained bounces, like a dead cat bounce? Catch a falling knife. Ow! I hate when that stuff happens. Dumb money, retail traders, novice, sellers who close their position. That's the correct answer, Alexander. Herd mentality, short covering, right, Mark? Short covering to reduce the risk. Eric, yeah, you guys right. That's short covering. That's not new buyers coming into town. All right, so absolutely correct. Good answers. So learning has occurred. So in our current market, I tested hundreds of trades with this the last couple of weeks. even if they sell off substantially, and I correctly bought what in a normal market on a bounce would have been good for maybe a mean reversion pivot, I'm not seeing mean reversion pivots. I'm not seeing these guys bounce back up to the midpoint and then fade and you sell up there. That's not occurring because of all the pessimism in the street. So don't be a dip buyer, is my word to the wise. That's some interesting charts like Canopy Growth, one of the pot stocks. I was trading Tillery, TLRY earlier too, and PLAG I want to say. But I like the ETFs, the right instruments to trade. Last Saturday I told, and that's the day before this day, I told my traders we look for a long in ERY at 38.50. I wish I had taken that. I was off trading my inverse ETFs, not the ERY, but that one did continue on up. I think that is an inverse, right? Is that inverse or energy? I should know that, right? It's an energy bear, so it is an inverse ETF in energy sector. So while the talking heads on TV are saying energy stocks are beaten down and you should be buying them, derp. I think not, Sparky. I was telling my traders last Saturday, which is the day before this day, we go long, and that was the chart of the week. If you got my email, 38.50 was my long call in ERY. Now, where makes sense for a new trade? Where do you think my swing scans pick, which I teach people how to scale in? Where do you think a next play would be? Again, we don't buy nines. Now would be a good time. By the way, if you took that 38.50 long call, congratulations. Now would be a good time to sell it or tighten in a trailing stop to say, right, 44.8. That's how I'd trade it. But where would be the next play, given that we do not buy nines? Pardon me while I imbibe my coffee from my Bellagio coffee mug. You know, one of the neat things about trading like a champ is you make so much money, you can do things like I like to take my family to Bellagio and we get the Bellagio suite with the floor-to-ceiling glass and eat at the buffet and go to the Osho and hang out at the pool, which is fun, especially in the early morning. That's a tip. When you go to Vegas casinos, they're kind of like empty until 10 o'clock because everyone's sleeping it off or whatever. I don't drink, so my family and I, we get up at like 6, 7 in the morning, go down to the pool. I think it opens at 9:30 or something. Anyway, I digress. Yeah, 50 and a quarter, 50-50. Thanks, Mira, Don, Trey, Louise, Phil, Norman, Shannon. Somewhere north of 50 is the right place to go long this guy. So we don't, and again, because we anticipate selling pressure between 49 and 50, which is why I use 49. You may have seen my stocks and commodities articles. I use stuff with 9 in it as a good exit target. And that's a good decade value trade setup. I got them in earlier than that, which is congratulations if you took it. But the point is, even if you buy 41, 42, sell 48, 49, that's a good round trip within a 10-point trade window. What's going on commodity-wise? Gold doesn't look good. I closed out my Barrick position earlier, thankfully, I guess, because it's not going up. Oil doesn't look too exciting to me. The only thing that I'm trading right now is the inverse ETFs because they're what's getting institutional money flow. Another quick tip, kind of a poker tell, is follow the volume. And when you see people are putting on large size, like look at the large volume spike here. Look at the volume in the VIX ETNs, right? That is substantially higher volume. Look how big the volume bars are here compared to back there. And if you look at the 10-year in this, back during the last time the market sold off, split adjusted, it was only, what is that, $200 million or whatever, or $21 million, something ridiculous. Huge price improvement in this guy. So what I like, the price that proves these guys right, especially for scale-in trades for the inverses, is whenever they break above the 200 SMA. Like FAZ, the finance triple, way up, right? Cracks in the market occur from, if you look at bond yields too, which I don't really, but the cracks in the market comes from the Russell, your small caps, and your finance. Whenever finance and small caps start to weaken and crumble, that's not a good thing for the broad market. Like Citigroup, banking stock, taking it in the shorts, right? That is a bearish sign for the market when Citi drops. When the sector If you look at the finance sector, you can see recent weakness. So the trick is making money with charts that actually have a shot at working out. And that's something that I cover. I've got long alerts for a lot of these guys in my Swing Scans episode coming up in 15 minutes for all of my Swing Scans members. And of course, we cover intraday breakouts for things that are doing good in spite of the market, like Twitter. You know, I had a winning call for my traders in Twitter on Thursday. That's the chart of the week. I got them in at 32.20 and we sold into the whole number at 33. We didn't get the exact top, but we got a good 70-80 cents of the breakout here. So charts that are beating the market selectively, carefully, good for intraday trading only. You really should not be swing trading anything other than bear instruments in a downtrending market, because you know, you get these dead cat bounces that don't work out. I tried and I took a lot of stops, thankfully small, trying to pick oversolds, right? So be careful out there is my word of wisdom. Like IGC, I was trying to buy a bounce in this guy earlier, got stopped out. Lots of upside potential, and this is one that I do have a trigger for in my small cap scans advisory in case it comes back to life. But you only want to trade guys like this one or that PLAG one I was trading that went 4 to 7. Charts with big ranges that do some kind of recovery are few and far between in our current market. So you do want to be cautious out there. You want to trade things that have reasonably consistent uptrends. Another quick tip for day traders, one that I've been day and swing trading, is LABD. It's the Biotech Triple, and it doesn't look too exciting on this chart. Looks more exciting on the Wednesday chart. But look at this guy. It even beats TVIX from a volatility standpoint. Intraday swing trading is one technique that I'm covering in the live trading room for all my traders. A big turnout too. We got a lot of new members. Welcome aboard. As well as small caps. Finally, the small cap cheap stocks are showing enough volatility and volume to be worth considering. They hadn't until this recent volatile drop in the market. So I'm now, at long last and requested by hundreds of folks, is covering the under $10 stocks like the IGC one that do, or PFAG, whatever, PFLG, whatever that one, ones that have really big ranges and volume and clean, tight patterns that are easy to trade. But anyway, another quick tip is intraday swing trading, where you put on the trade early in the day, say 50 cents above a cut pattern high breakout, then close out the trade 3:30 or so. You don't have to close it out at 4. And I will close out. I like to get most of my trading done by the close. There's 3 windows of opportunity in the market each day. The open range breakouts from 9:30 to 10, 10:30 at the latest. The midday reversals around 11 or 12. And then what goes on between 3:30 and 4, whether it gives it back or continues up or holds steady. So that within those 3 windows of opportunity, that's how I'm trading. And intraday swing trading, where you take advantage of that first window breakout instead of just scalping and then out, which is my preferred way to day trade. But in our current markets, the volatility is extended. And so oftentimes you'll see the big epic runs like this LABD. It's the Biotech Triple Bear. So this goes up when biotechs go down. Remember, I was seeing a commentary from Nigerian on CNBC about there's a lot of bearish activity in terms of put option activity, big blocks of puts being bought in biotech. So that might explain it. But anyway, intraday swings. I mean, do you think you could make some money if you bought 36 and sold 42? 6 points? You know, even on just 100 shares, you're up 600, right? So it's all good. You got a hot market. It's a good time to be trading it. As an active trader, you owe it to yourself to be focused on those kind of charts that have the best outlier potential, the ones that have the best sustainable trends. When they run, they're hot. When they don't, they're not. But be ready for it. And that's where I come to the rescue. That's where I got so many traders in my live room and all that. We focus on charts that actually have big trade potential and actually have a shot of running. So any questions? By the way, not much going on in the currency markets. Those charts are not blowing my hair back, so I'm not trading FX currently. I used to trade FX, mostly the dollar yen, but currently I think the dollar CAD, not a great chart, but a reasonably good uptrend. So for the Forex traders, the US dollar to the Canadian dollar is in an uptrend. I don't see any extremely strong charts out there, so it's more a scalper's market than a swing trader's market, but the dollar CAD is the best of the uptrending charts I can find for you. So if you do trade FX, that's my pick. You've seen how good the picks work out in weeks past, right? So usually pretty good. All right, we're about out of time. I wanted to thank all of you for being here. Sincerely appreciate it. We've got the Swing Scans members webinar coming up with all the good stuff in 10 minutes. So if you're not yet a member of Swing Scans, join now. I won't be able to get you into the webinar because I'm starting in 8 minutes, but I'll get you the recording later today in the members area. You're right, TJ, about the talking heads. I agree. FAZ2, right. I'm seeing if there's any questions. Bill saying, do rules like sell near multiples of 10s hold for leveraged ETFs? Not as much, and that's a smart question. I don't use the whole number support resistance or the multiple of $10 range rule as much for the leveraged ETFs because they have so much volatility, they usually exceed or blow out those levels. That's a smart question, and you're right. So no, that's for index tight instruments. I don't use the whole number and 9 rule nearly as much as I do for regular instruments because especially the leverage, the double and triple. So smart question. I like those kind of questions. They're good. Smart traders here. I like having all these smart people. Yeah, PLAG, that was it. Pissed me off. I bought 30 shares at $4.50, sold it the next day at $7.40 for all of like a $90 profit. It could have made hundreds or thousands if I had traded heavier, but I was putting on a baby trade. Hey TJ, I like Tasty. Yeah, they're good. Question from Don, what stock charts are good for the inside range gaps? The pot stocks lately have been pretty good, like TLRY, CGC, some of the others, but not so much. You know, now's not a good time to be a bull in the market because we got a big blanket of sell pressure crushing the market. Earnings disappointed for Amazon and Alphabet last week. We've got others coming up to bat next week, and then we got the midterm elections, and so a lot of market moving events, plus the Fed with recessionary fears looming on the horizon despite a strong economy and a good job market. I sound like a talking frickin' head now. Stop it. I've been watching too much of that. So I stopped watching financial news TV like 14 years ago, and I've only recently found out that they put all these great little clips on YouTube. So I've been watching a bunch of these little 4 or 5 minute YouTube videos. And stop it. I'm going to stop watching that because that stuff rots your head. What counts is price action. All that matters is the frickin' money. I mean, that's just me. I'm in it for the money. I expect to get paid. I'm not in it for the revolution or the talking head forecast. I'm refreshingly honest. So I like to call it like it is. What I think about the melt up. Thank you for your good work. Have a good weekend. Hey Long. I think until the market, if it ever recovers and stays for 3 days or longer above the 200 SMA, I would treat any bounce days as intraday opportunities only, but not to initiate swing trades. That's one of my key lessons learned the last few weeks. It's not a market. It's kind of like speed bump on the way down, right? We're in a downtrend, so you should fade or go short at any rollover of a bounce that then goes down. But it's not a good time for a melt up unless the S&P recovers that critical 200 SMA level of that 2770. We lost 2700 yesterday, right? That's a key support level. Another quick tip, it's often for bearish sentiment, it's often a good idea to be a bad news bear like I am going into the weekend, because often mom and pa kettle at home are saying, holy crap, what should we do? And they issue a bunch of sell orders in their IRAs and their mutual funds, and they say, yep, mom and pa, we should sell it all. So you get a lot of weekend selling pressure that then translates into a gap down on a Monday. So often you'll see a Monday gap down following a sell pressure like this. Now, if the market screws me, which it has done so repeatedly, I learned the hard way. But I'm a survivor. I learned this stuff, right? Pardon my French. If this guy, say, gaps down here and starts to crash and burn, let's say gaps all the way down here on Monday, because we got a bullish market on Monday, I will still use the whole number support at 36, and I'll stop out at, say, 35.7. And if it keeps going down, that's great. I'll rebuy off the lows. I will still reacquire my shares if the market proves me wrong by rallying to the upside. I will still reacquire my shares. My goal, what I've been doing successfully, correctly, is rebuy off of pivot lows. And then you get the gap up like this, and that makes it all good, right? So that's what I did here. I bought here. I took small stops here. I rebought on the close, and now I'm back in the money, right? So that's a good, advanced trading approach for ducking and weaving in the market. But these are the kind of charts that make sense, right? I've got to run. I got swing scans coming up, gang. Thanks to everybody for being here. Where's the money going if not the market? Hey, John. Well, my money's going into the bear ETF, so I'm shorting the market. So that's where I'm going. I don't see it going into oil or gold. It may go into bonds. It may go into real estate. It may go into crypto. It may go anywhere. But it's not in equities, I could tell you that, at least the long instruments right now. You will see some upside pressure from value dip buyers in the sectors that are referred to incorrectly as oversold, specifically home buyers. We've got home buyers, energy, healthcare, and software are 4 sectors for growth. If you are a bull, those would be, especially healthcare is the #1 lead sector. If you are a bull and you're insisting on being a bull in a bear market, that would be the first place from a relative strength standpoint to look at for potential recovery. Anyway, I'm Ken Calhoun, your host, and if any of you are out there from Talking Head City, I'd be happy to be on, Fast Money or one of the episodes. I would even take time out of my insanely busy schedule to fly out to New York City. It's all good. You guys take care. Kick the market's ass. Crush it out there. The opportunity's there. So is the danger. So be careful and know what you're doing. Do sign up for if at no other time in your whole frickin' life, now is a good time to at least, for $7, money back guarantee. I got lots of money. I don't care if you stay or go. Don't let the doorknob hit you on the way out if you go. But try out my alert services and my coaching. I'm the real deal. I'm authentic. I'm Ken Calhoun. Wishing you guys the best. Get out there and let's go get them. See you guys next time. Bye for now. I've got swing scans coming up. I wish I could stick around, but duty calls. So you guys take care. And do be safe out there. Be safe. Like Mr. Wonderful, Kevin would say, treat your dollars like they're soldiers. You send them out there. You don't want to have half of them decimated. You want to go out there and capture some prisoners and bring back more than you went out there with. That's what I aim to do in my trade. So take care. Best wishes for trading success. Join me now at trademastery.com, and I'll see you guys on the other side. Let's go get them. Bye for now.